Welcome back, everyone. We've got a truly fascinating explainer ahead of us today. We're unpacking the latest first quarter fiscal 2026 earnings report from Land's End. If you're the kind of person who loves figuring out what's really going on beneath the surface of a major retail brand, well, you're in exactly the right place. Because let me tell you, this report, it's full of twists.
Okay, let's dive right into this because there is a massive paradoxical discrepancy in the headline numbers that we absolutely need to figure out today. Usually, right, when a company tells you their sales dropped by 8.5%, you'd expect to see some real pain on the bottom line. But instead, Land's End suddenly reported over $330 million in net income for a single quarter. I mean, how on earth does that happen?
To solve this mystery, here's our roadmap. First, we'll unpack that first quarter paradox. Second, the warehouse disruption. Third, the WHP global catalyst. Fourth, European growth bright spots. And finally, the fiscal 2026 outlook.
Starting off with Section 1, the first quarter paradox, unpacking the iceberg.
Just look at the sheer scale of this turnaround on paper. Back in the first quarter of 2025, Land's End reported a net loss of $8.3 million. Fast forward just 1 year to Q1 of 2026, and they're suddenly reporting a net income of $330.7 million. In a really tough macroeconomic environment where retailers are basically fighting for every single dollar, seeing an earnings jump of that magnitude is practically unheard of. It's wild.
And just to anchor us in reality for a second, this is exactly where those wild headline numbers are coming from. The official Q1 2026 earnings announcement straight from Land's End. Now, you know as well as I do, when a report kicks off with numbers like that, there is absolutely a deeper story hiding in the fine print. So, let's figure out what was actually happening on the ground with the company's daily sales.
Moving into Section 2, the warehouse disruption, or when renovations stall traffic.
So if we look at the actual scorecard for the quarter, a pretty clear gap in the narrative starts to emerge. Almost all of the U.S. segments took a significant hit. U.S. e-commerce, down 10.2%. The outfitters segment, the part that sells uniforms to businesses and schools, down 10.3%. Even third-party sales dropped 5.7%. Honestly, the only real winner here was Europe e-commerce, which shot up 14.5%. We'll definitely talk about Europe's success a bit later, but clearly the core U.S. business was struggling to actually fulfill orders.
And visually, here's what that operational reality looks like. Total net revenue fell from $261.2 million in Q1 2025 down to $238.9 million in Q1 2026. That is a total decrease of $22.3 million. And look, when your sales shrink by over $22 million, your core business is contracting. So, what caused this? Why weren't they selling as many clothes?
Well, the culprit wasn't necessarily a lack of consumer demand. It was actually a massive supply chain traffic jam. Land's End was in the middle of rolling out a brand new warehouse management system in their U.S. distribution centers, and anyone who's ever lived through a major software or operations upgrade knows it rarely goes smoothly on day one, right? They had a disruption that forced them to deliberately pace their shipments well below normal capacity. It's kind of like trying to completely renovate your kitchen while you're still cooking a massive Thanksgiving dinner for a huge family. Things are just going to slow down.
Now, the company definitely wants investors to know this is just short-term pain for long-term gain. CEO Andrew McLean stated it pretty directly, saying, "We experienced a temporary operational disruption tied to our U.S. distribution center upgrades, which caused a timing issue, and it is behind us." In fact, according to the company, if you exclude this temporary disruption, they estimate they would have actually delivered low single-digit revenue growth for the quarter. So, the traffic jam is clearing up. But wait, that still doesn't explain our $330 million paradox, does it? Which brings us to Section 3, the WHP global catalyst, the $300 million reveal.
So the real secret behind that massive $330 million profit lies in a joint venture, or JV, with a company called WHP Global. Essentially, Land's End engaged in a strategic transaction where they transferred their own intellectual property into a new partnership. Now, you might be wondering, why would they do that? Simple, to monetize their own brand name and unlock a massive, immediate pile of capital.
And exactly how much capital are we talking about? $300 million in cash proceeds. That's a huge number. This wasn't money made from selling winter coats or polo shirts. This was a complete windfall from leveraging the brand's intellectual property. And Land's End put this cash to work immediately. They used the vast majority of that $300 million to completely wipe out their term loan debt. Just poof, gone.
And we can see exactly how this played out right here in the official filings. Over in the balance sheet highlights, management clearly notes that they used the majority of those $300 million cash proceeds to repay that term loan. And then, checking the cash flows from financing activities, you can spot a massive $234 million payment on the term loan. This transaction fundamentally altered their capital structure. I mean, it gave them a much cleaner balance sheet going forward. Which brings us to a really crucial bit of jargon translation. So, that GAAP net income of $330.7 million, that's what you see in the flashy headlines, but it is driven almost entirely by the one-time accounting gain from that WHP Global joint venture. It's a structural finance event. However, if you look at adjusted EBITDA, which is the metric that measures the actual day-to-day operating profitability of the business, it was actually negative $6.2 million. Yep, the real retail operation actually lost money this quarter because of that warehouse disruption we talked about. So, Paradox solved. Some really clever financial engineering basically masked a pretty tough operational quarter.
Moving on to Section 4, European Growth Bright Spots, validating the core strategy.
Remember earlier when I mentioned the company believes they would have had revenue growth if it weren't for the warehouse glitch? Well, CEO Andrew McLean backs this up, stating, "Our first quarter results reflect a business with real underlying momentum. Our solutions-based strategy is resonating with customers." He even noted that consumer traffic was actually up double digits and new customer acquisition improved. And to prove this isn't just talk, we just have to look across the Atlantic. Over in Europe, where the distribution centers were totally unaffected by the U.S. warehouse rollout, the business absolutely thrived. Europe e-commerce net revenue jumped from $17.9 million in Q1 2025 to $20.5 million in Q1 2026. That's an impressive 14.5% increase. It serves as this really powerful proof of concept. When Lands' End can actually get its products out the door efficiently, consumers really, truly want to buy them.
So what's working so well in Europe? Well, the report notes that this success was driven by a strategic shift to a franchise-first assortment. Essentially, they stopped trying to sell everything to everyone. Instead, they focused solely on curating their core, most successful product lines. This simplified the whole business and drastically improved their inventory efficiency. Not only did revenue grow 15%, but their gross margin in Europe actually expanded too. It's basically a blueprint for what a healthy, streamlined Lands' End looks like when operations are just humming along.
And that brings us to our final section. Section 5, the Fiscal 2026 Outlook. What to expect next. Looking at the specific forward guidance provided by CFO Bernie McCracken, wiping out that term loan debt significantly reduces their interest burden. And look, this isn't just about making the balance sheet look pretty for investors. Removing that debt gives the company enhanced financial flexibility to actually reinvest back into the business and return capital to shareholders. Based on all these new realities, here's what the company expects for the full fiscal year 2026. They're projecting net revenue somewhere between $1.30 billion and $1.40 billion. Net income is expected to settle between $310 and $320 million, basically holding on to the gains from that joint venture. But more importantly, adjusted EBITDA, remember that's our measure of real day-to-day operational health, is expected to rebound right back into the black, landing between $68 and $78 million for the year. They also plan to spend about $40 million in capital expenditures to keep things moving. Which leaves us with this final, provocative thought to chew on. Is this incredible Q1 paradox the foundation of a great American brand comeback or just a temporary balance sheet sugar high? Management has brilliantly bought themselves time and flexibility by monetizing their IP and wiping out their debt. But now, with the warehouse upgrades supposedly behind them, the pressure is really on the day-to-day retail operations to catch up to the balance sheet. They've got the capital, now they need the sales. It's going to be absolutely fascinating to see how the next quarter unfolds. Thank you so much for joining me on this explainer, and keep learning.